Let's keep it here. Who else would it be? There is a lot of talk out there right now about the DXY. More recently, we just hit basically a new low for the past 1,000 days. We're going to take a look at this. Okay, it's going to be a little bit of a brief video focusing only on the DXY. We might go into some treasury bonds towards the end of this video, but we're going to take a look at what really is the DXY. A lot of people don't really understand what it is and what it entails and how that kind of works. So we're going to look at what it is, what it does, and how that it may affect you, or at least it may affect the tariffs, and kind of just go down that context road to give you a more understanding of what the DXY is. Because a lot of people are really freaking out about this. This is the first time it's been under $100 really since 2023. It went down even lower back from to the April 2022 marker, and so a lot of people are concerned. And I don't think they should be as concerned as they should be. A lot of people think it's going to be, their money's going to be worth less, and there could be some truth to that. But we will need to look at this and figure out what exactly does this mean. So go ahead and hit that like, subscribe. Let's go ahead and get started. So first things first, we're going to talk very briefly about what the DXY actually is. A lot of people, especially when they start trading or they get involved in charts, they just know that this is a chart that people follow. They follow this, they follow the bonds, they follow, single family mortgage rates, things like that, gold, Bitcoin, stocks, things like that. And a lot of times people have a tendency just to follow charts because other people are following charts and those people are following because other people are following. And so you get this long chainmail string of people that just look at charts without actually caring what the charts actually mean. Okay. And so most of you guys know I'm a very big fan of being a chart purist. I don't look for correlations in different markets necessarily. I don't try to seek them out. I look at, okay, what does this particular chart say? So when I look at Bitcoin, I look at what does Bitcoin say? What are the patterns? What's the momentum look like? Anything I can get from data points in that chart. Now, the same thing applies to the DXY from my standpoint, okay? But you also have to understand what the DXY actually is. And I don't think people really understand that this is an index. You got to be very careful. I don't think people realize that the DXY is an index, just like the S&P 500, where it takes the 500 stocks in that regard. The U.S. dollar index actually is of course, an index of 6 different currencies. And we'll take a look at 6 of these currencies here. I apologize for the lower resolution. I tried to come up with a good chart, things like that. It's taken too long. I actually I don't know where this came from. I got it off the internet, but I don't know. Unfortunately, I can't give a source. I don't know where it came from. There's no watermark. So I apologize. If you know who this is, let me know. I'm happy to shout them out. But the dollar index, the DXY is the dollar index, and it's composed of 6 different currencies. It's composed of the euro, the Japanese yen, the British pound sterling, the Canadian dollar, the Swedish krona, and the Swiss franc, and they're weighted respectively. The euro is about 57%, a little over that. The Japanese yen is about 13.6. British pound sterling, a little bit, or just under 12. Canadian dollar is about 9. The Swedish currency is about 4.2%, and the Swiss franc is 3.1. And then it's also calculated based off of this formula. It's basically all of these times each other, and then divided from them, right? So it's weighted in that regard. And there's a reason for that, because the one way we look at this gives you a really good frame of context, because a lot of people just want to assume the dollar is just whatever we determine it is, whatever the value may be from the United States. And there's a lot of truth to that, actually. When we start to do inflation, when we start to print more money, that does tend to come up. Okay, that does tend to inflate things a little bit more. However, we also need to compare our currency to other currencies to see how strong that they are. So we use these, and now you know, there's aside from Canada and Japan, these are European currencies. Okay, Canada, of course, is North American. Japanese, of course, is Asia, and so this also gives us somewhat of not the biggest weight, but it gives us more of a global context relative to these economies. Okay, and that's another key thing is these dollars from these respective areas of the world are also going to be weighted from their own currencies as well, or from their own economies, I should say. So that is why we have the index. And now some people, going back to the actual index on TradingView, some people want to assume, well, okay, so since the percentage here is going down, that means that the US dollar is getting less value. Not necessarily. Okay, yes, there is some truth to that, but it's also weighed against these other currencies. Okay, so it's going to be going down relative to these currencies. That's why you have a fluctuation of these numbers. So someone might want to beg the question, well, if the DXY is going down, that means the dollar is being worth less and less and less. And so the answer to that question is this complicated. It's very complicated, and it's not much different than the Bitcoin dominance chart that we tend to talk about. I've referenced that Bitcoin dominance has an inverse correlation to how performative crypto tends to be. If the Bitcoin dominance rises, that means that doesn't mean that Bitcoin's going up in price. In fact, in many cases, that means it's going down in price, and that everybody in the market is selling, but people that have Bitcoin are going to be selling less, or they're going to be moving their altcoin portfolio to their Bitcoin portfolio. People are still doing that. Okay, the dominance is up pretty good here in the past 2 or 3 years, even more than that. Okay, it's starting to make an all-time high. It's very close to its all-time high versus 2018. Okay, so about 6-7 years there. So just keep that in mind. And so the same thing applies here to the DXY. Just because this goes down does not mean the value is going down. It just means it's going down in value relative to other currencies. Now, that's going to play a big deal, however, as far as global economies work, because we are comparing ourselves to other currencies, especially Japan right now. Like the Asian markets are more crucial right now with China and everything going on. We don't compare ourselves to China for the index, okay? But as far as all that goes, just because the dollar value is going down doesn't mean that the value is going down. It just means it's going down compared to other currencies. Now that could mean a few different things. It could mean that they are all going down in value. That's certainly true. It could mean that they're all going up in value as well. It could. Just that the US dollar is not going as high. Let's say it's only going up 2%, where Japan's going up 3, Euro is going up 4, British pound's going up 5, things like that, right? So if the US dollar is worth less than the other ones, that does not mean that the value of the dollar is worth less, just that it's worth less to other currencies. And so that's how the US dollar index works. Now, a few other things in regard to that, relative to the tariffs, that does present a big deal because we're basically on a global scale from the United States perspective, just targeting pretty much every country in the world as far as the tariffs go, and I think that does have a chance to weaken the dollar. Okay, the second thing is typically, not always, but when you see a decrease here in the DXY, typically that means Bitcoin is going up. Bitcoin is a risk asset, and you see the market is up pretty well responsively today. It's doing pretty well, and so that could have something to do with it. Maybe not, but the point is, you typically, if the dollar index goes down, usually everything goes up, because not always, but the theory is that it goes up because you're going to have more dollars to spare. So it's not so if you compare this to Bitcoin, it's not that Bitcoin is necessarily worth more money. It's just that there's more dollars per Bitcoin to spare, if that makes sense. So there's a little bit of similarity. It's a little bit different at the same time. So let's kind of get here into the TA aspect. I'm going to cover the technical analysis portion, the actual chart. Then I'm going to briefly go over to the U.S. 10-year Treasury bonds. I actually looked at this a few days ago, but I'm going to look at this again to kind of compare, because a lot of people are really freaking out about this, and I don't think it's anything to freak out about. I think it's okay to have some sort of middle ground here. Obviously, you want a strong dollar, and you want a high dollar index, but that does not necessarily mean things are terribly bad. So I'm going to zoom out here just a little bit. We're looking at the monthly here. I do want to mention here, like 1984 was a pretty high mark, about 161. Like we had a very strong economy in the 80s. Not a lot of people don't remember that, obviously, because that was like 40, 50 years ago. But that's just kind of how it was, and it was pretty strong. One of the lowest ones was the financial crash, okay? And so that was roughly about 2008. So I think it was roughly around this area. It might have been right around here. I can't remember exactly. I think it was late 2008. And then you also had the biggest marker for that was COVID too. So I'm gonna mark the 2008 here. So I'll just that's close enough. And then we're gonna look at was it March 2020? Okay, so this was the local top here. So we can see two different reactions here. With the housing crisis, we actually had an increase, and then we kind of fluctuated back and forth. And so this was a strange time of the markets here because we were trying to restabilize, and we ended up stabilizing. Definitely not where we were. We were definitely higher than where we were now then. Um, but this is where I look and see, like, just because the dollar index is high doesn't necessarily mean that the value is high. It's just the value is high compared to other currencies. But if everybody's printing money, for example, then that kind of nullifies that, and then we're going to come down. This is exactly why stocks come down, by the way, as well. A lot of people think that just because a stock price goes up super high means that it's valuable and things like that. And obviously, like, you can sell it and get that money, so there is value. But you also have to look at the value proposition. Like, is it worth this much? Is Nvidia worth this much? And the answer is not always. And that's exactly why markets go down. It's supply and demand. Okay, once the supply is extended or demand is extended, it tends to bounce back to where it was. It's the whole point of what I call, or what is called, mean reversion. I'm a big fan of mean reversion. That's Mean reversion is one of the ways I've learned to use patterns so well, is because what comes up must come down, okay, and what goes down must come up, okay. It's you view these in terms of like a rubber band. Things are typically elastic, and the more that they aren't elastic, the more that they become elastic. So anyway, these are the two drops that we had, or the two big events. We had a big strong reaction from there to the upside. This one was to the downside. But right here is where what I'll look at is that relative to the current price, we actually touched down on this support zone. And this is a pretty big marker here. A lot of people, I think, are freaking out because we're looking at this. And I don't really view it this because, one, this was not stable. This actually deviated. Now it deviated again. This is a much better context here because this gives us the swing high order block, gives us the retest, and this is a deviation. Okay, so you still only have one deviation. Then you had a retest, and then this was respected, and this is still respected. So a lot of people are looking at this, I believe, a little bit, um, wrong. I should say. I don't want to say wrong, but it's the only word I got. And so we're still holding this. So if we can hold this, I think everything's gonna be okay, right? I'm not too concerned if this goes down. Honestly, I'm not too concerned if it goes either which way from 112 to 88. I think, or yeah, 88.9. So as long as we stay within this range, I think we're gonna be okay. As far as the index goes, not too concerned overall. Obviously, this is a little bit lower. I think is not going to hurt the markets. A lot of people are disagreeing with that, but we'll look at the bonds and take a look at it here in a second. We had a high bearish cross here at 82%, which tends to happen. We had one here right before the drop, okay? And so let me go ahead and mark this out to give you a little bit of a context here. We did not really have any other cross at all on the high side except for here, okay? And this gave us a slight drop as well. So both of these gave drops, but this was a really good recovery, okay? This recovered soon after, okay? Maybe about three to 5 months after that. That's pretty soon for DXY. And the other one here is that we actually held down low. This was a pretty big event, and this recovered as well. I think what it boils down to is, do you think everything with Trump and the tariff stuff, do you think this is a COVID level event? I think that's really what this boils down to. And I strongly do not think that it is. I am in the minority that I honestly don't think this is a big deal. I understand why people think it is a big deal, but I also, based off of the numbers and the data points, um, the people that think that it is and are using data to do so are kind of forcing something that isn't there just yet. It may be. I'm not saying that there isn't, but I don't see it, um, at the outset. And so addressing people in Bitcoin in particular, like you guys, like, I don't know if you guys want, a lot of people with Bitcoin want higher prices. I mean, we're up about 10% here in the past 4 days, and but people are still kind of bearish here, but we're getting ready to cross this zone. Okay, so it's one of those things, like the DXY going down does typically indicate that Bitcoin's going to go up, or has been, or historically at least. And that's what a lot of you guys are wanting. And so it's one of those things like, don't look at an asset like DXY and think, well, our money's going to be worthless. That's not necessarily going to be the case. For me, from what I'm seeing, that just means Bitcoin's going to get stronger. Same thing here with gold. We looked at gold before. We looked at all of these yesterday in my yesterday's video. Go ahead and check that out if you haven't. S&P's up almost 2%. Coffee's up 4%. And gold is up 1.6. And so, and we looked at yesterday as a target for 3,500, and we're already halfway there after two candles. So go ahead and check that out. But I do want to look at the US 10 yield just to end the video and kind of see, a lot of people were talking like there's an inverse correlation between the bonds market 10-year and DXY. And so for at least the past few days, there has been, my focus isn't the correlation, because the correlation doesn't tell you anything. How are you going to trade this? What does this mean? Okay, like if you can't make money off this, you need to just log off and not be concerned about the correlative or not correlation of the markets. Just kind of look at what this is doing. The DXY has been going down, and it is what it is. But as far as the bonds, they've been going up, and it's needed to go up. And I've talked about this in the previous video, is that we the bonds have been going down pretty substantially, and now they're starting to go up, and this is a good sign here. This is something that we really need. And so this is, I don't think there's enough data to really doom and gloom anything here. Like, this is going down pretty much since the 80s. This is, mortgage rates have also been going down. Like, and so I think there's some consideration here that I don't see anything unhealthy at this point. Okay, I understand messing with the markets. I'm talking about Trump here, like him messing with the markets is going to cause a lot of chaos. But so far, I think everything looks good. We're retesting the 50 here, and I don't have too much. I'm not concerned here. Okay, because everything is looking fine as far as how all this measures up. So don't think that your dollar's just getting worthless all of a sudden. Like I said, the mean reversion, things are going to go up and down, and it's going to, you got to focus on the long-term trajectory. So anyway, that is the video. Let me know what you think. I'm happy to talk about more things. Go ahead, like, subscribe. Have a good weekend.